If you had put $10,000 into Tesla 2 years ago, your investment would now be over $90,000. Yes, you heard that right, and this is just the beginning. The renewable energy sector is projected to grow exponentially over the next decade, with forecasts suggesting a 15-fold increase in market size by 2032, translating to an impressive compound annual growth rate of approximately 45%. That's 4 times higher than the average return of the NASDAQ index over the past 10 years. As you may have noticed in several other sources, I carefully selected these 5 stocks for their potential to outperform, providing a solid foundation for a diversified investment portfolio aimed at renewable energy and sustainable technologies. It's important to note that this list is not exhaustive and can be supplemented with additional stocks or ETFs based on individual preferences and risk appetite. Moreover, I am not a financial advisor. My expertise lies in environmental science and sustainability, with over a decade of experience in researching renewable energy technologies and their practical applications. Therefore, the insights I share are intended for educational purposes only. Now let's delve into the details of the first stock. The portfolio comprises a mix of large-cap and mid-cap companies, with the allocation towards each stock based on rigorous analysis and growth potential. While the top 5 holdings carry considerable weight in the portfolio, the strategy aims to balance stability with growth. For instance, the leading companies in this selection include NextEra Energy, Tesla, Enphase Energy, Vestas Wind Systems, and Plug Power. Each of these companies has demonstrated strong performance in recent years, with NextEra Energy leading the pack with a remarkable 25% increase in stock value year-to-date. Similarly, Tesla has surged by 40% in the past 6 months, highlighting the robust growth potential of the renewable energy sector. Despite the stellar performance of these key holdings, the portfolio has delivered a solid return of 18% this year, showcasing the benefits of a well-diversified investment approach. In comparison to the S&P, the performance of the NASDAQ in 2023 was exceptional, with a staggering growth rate of 54%, surpassing the S&P's 26% growth during the same period. This remarkable achievement occurred during one of the most prosperous years in the history of the stock market. Interestingly, the top holdings in the NASDAQ mirror those of the S&P, comprising Microsoft, Apple, Nvidia, Google's Class A and Class C shares, and Amazon. Despite this similarity, the NASDAQ 100 has outperformed the S&P 512 out of the last 15 years. Additionally, the NASDAQ includes non-US companies such as ASML, a Netherlands-based firm renowned for manufacturing advanced lithography machines utilized by industry giants like Intel, Samsung, and TSMC in producing cutting-edge semiconductors. Moreover, the NASDAQ tracks 100 companies, offering a balanced level of diversification compared to the S&P's 500 constituents. This focused approach allows the NASDAQ to capitalize on significant market movements, making it an attractive option for investors seeking substantial returns without compromising on security. A key insight to consider is the gradual evolution of the mobile internet ecosystem over an extended period. While the presented chart spans from 2010 to 2016, the inception of the iPhone dates back to 2007, followed by the launch of Apple's App Store in 2008. The transformation brought by the iPhone, transitioning from BlackBerry to widespread adoption, revolutionized mobile computing for both businesses and consumers. Furthermore, the emergence of 5G technology commenced in 2018, emphasizing the importance of patience in navigating investment opportunities within the tech sector. Moreover, high-margin software and service companies, while typically delivering superior long-term returns, represent the final stage in the tech stack for generating revenue. These entities operate within data centers or on edge devices like smartphones, tablets, laptops, desktops, and upcoming innovations such as self-driving vehicles and humanoid robots. Prioritizing investments in the foundational infrastructure and devices driving technological advancements can yield substantial benefits over time. These advanced software platforms have the potential to make significant advancements on their own. In contrast, semiconductor companies are tasked with producing the chips that drive these innovations. Rather than attempting to predict the future dominant players in artificial intelligence, some of which may not even exist yet, a strategic approach involves gaining broad exposure across 3 pivotal AI sectors: semiconductors, hardware infrastructure, and software. This alignment is precisely targeted by the following trio of funds and how they synergize. For semiconductor investments, my top pick is the VanEck Semiconductor ETF, symbol SMH. which monitors the leading chip manufacturers listed on major U.S. exchanges. This ETF stands out for several reasons. Firstly, it focuses on 25 key companies, making it a highly selective fund. Among its top holdings are Nvidia, Broadcom, AMD, and ASML, collectively constituting approximately 51% of the fund. Notably, Nvidia alone holds a substantial 20% weight, emphasizing the concentrated nature of this ETF. Given this concentration, coupling the NASDAQ 100 with SMH provides an enhanced exposure to the semiconductor sector. Similar to the NASDAQ, SMH operates as a passively managed fund, boasting a modest expense ratio of just 0.35% annually. The fund has delivered impressive returns with a year-to-date growth of around 54%, a one-year growth of approximately 70%, and a remarkable 370% surge over the past 5 years. Notably, since its inception at the close of 2011, an initial investment of $110,000 in SMH would have burgeoned to over $200,000 today. The foreseeable future holds promise for semiconductor investments given the projected expansion of the global AI chip market by over 11 times in the next 9 years, translating to a robust compound annual growth rate exceeding 31% by 2033. In emerging or rapidly growing markets like this, semiconductor firms are pivotal in developing chips to train and empower sophisticated multimodal AI models and agents, such as OpenAI's GPT-40, Anthropic's Claude 3.5 Sonnet, and Google's Project Astra, built upon Gemini architecture. As new chip competitors enter the arena, SMH has outperformed many individual stocks in the market, showcasing its resilience and growth potential in the realm of generative AI. Investors must recognize that these foundational models serve as the infrastructure for the forthcoming generation of AI-based software applications, just as critical as the physical hardware they operate on. This understanding underscores the significance of the next fund on my list, the Roundhill Generative AI Technology ETF, ticker symbol CHH, which monitors a diverse portfolio of over 50 companies actively engaged in 4 distinct realms of generative AI. These platforms encompass companies involved in developing, training, and commercializing AI tools that empower third-party developers to create their applications, products, and services. Infrastructure companies provide the IT hardware and chips essential for generative AI workflows, as previously discussed. Additionally, enterprise and consumer software firms are crafting generative AI applications for business clients and direct-to-consumer markets, respectively. Noteworthy entities like Nvidia, Microsoft, Google, and Meta platforms hold prominent positions within this fund, each boasting expansive ecosystems replete with end-user services and applications, along with software and hardware infrastructure for other businesses to leverage. A standout feature of this ETF is its balanced allocation, avoiding an excessive focus on software companies beyond the major tech giants. Given that the premier generative AI companies are yet to emerge fully, the ETF takes a prudent approach, steering clear of premature judgments regarding winners and losers in the upper echelons of the AI domain. Despite carrying a 0.75% annual fee, making it the costliest ETF on my list, CHH is actively managed, introducing diversified stock rebalancing strategies. Launched in May 2023, CHH stands as the youngest ETF on this compilation, demonstrating robust performance since inception with a 40% return and a 23% year-to-date growth. As highlighted earlier, the global artificial intelligence market is slated to expand by 12-fold over the next 8 years, translating to a compound annual growth rate approaching 37%, distributed among hardware, software, and services segments. The surge in cyber threats has skyrocketed, with a 12-fold increase in phishing attempts as emails, texts, and even videos can now be generated effortlessly. Data theft and extortion have spiked by 75%, aided by AI-powered tools that make creating ransomware subscriptions a simple task with minimal costs compared to the havoc they can wreak. Consequently, while every company is heavily investing in AI, one aspect of their budgets they will never compromise on is cybersecurity. Forecasts predict that the global cybersecurity market will more than double over the next 8 years, equating to a compound annual growth rate of 11%. In parallel, the global cloud security market is projected to expand by 6 times within the same time frame, indicating a growth rate approximately twice as fast. Cybersecurity, much like artificial intelligence, encompasses a broad spectrum of elements. For instance, access management and authentication focus on restricting network access to authorized personnel, while identity protection safeguards individuals' data from theft, a realm where services like Delete Me come into play. Endpoint protection secures devices like laptops, tablets, and phones, emphasizing device security over user security. As generative AI continues to advance, each facet of the cybersecurity landscape is poised to outpace conventional predictions.